to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called ARM Holdings, ticker ARM. And as many of you guys know, the AI sector is creating a lot of tailwinds for many industries. And of course, semiconductors is one of them. So there's many companies out there that um, we can look into as a result of that. I've covered recently A-Lab, Astera Labs, IonQ, and so on. But there's many more, right? Why are we looking at ARM? Well, let's start from the beginning. In terms of the company itself has been around for decades, and ARM was known as the Switzerland of semiconductors. They didn't make chips, they just drew the blueprints, right? But they sold the blueprints to everyone like Apple, Samsung, Qualcomm for a tiny fee, staying neutral, very Swiss, of course, and low margin. So that was more of a volume business, ubiquitous but passive. And then the new CEO changed the story sharply. The company realized that in the AI era, their clients needed more than just blueprints. They needed the whole engine. So they started selling compute subsystems, which are pre-integrated packages, and launched a new architecture called V9. So that is just, it's not just a tech upgrade. That architecture allows the company to charge twice the royalty rate of the old version. So they have effectively raised the rent on the entire industry. And so that means that at the moment, right, especially after this sell-off, we see the valuation is typically quite high. But at the moment, we are getting at one of the historical lows that the stock has seen. And technicals, of course, suggest that the worst might be over, at least for the time being. So the reason for that is because investors are worried about a legal battle with Qualcomm. The underlying business is seeing a structural repricing of its value. And yes, again, we accept that risk that there might be some litigation with Qualcomm at the moment. But the argument is that that may already be priced in. And if it doesn't materialize, then of course we're going to see an explosive move to the upside. In the meantime, even if sales of devices around the world stayed flat, the company is meant to duplicate, right, the royalty rate. So that creates a pretty good baseline for us to consider going long. Now, in terms of the company, they have two revenue streams. The royalty revenue is about 60% of the sales. That is the cash cow. Every time a phone or cloud server chip is shipped, they get paid. And this is growing because of price, not volume. And then it's the license revenue. So that's about 40% of the sales. That is the upfront fee that companies pay to access their technology. And that has exploded more than 50% year on year because tech giants like Google, Microsoft are rushing to build their own custom chips, AI chips, and they need the company IP immediately. So why go along at the moment? Well, the trade is based on a divergence between business reality and market sentiment. The market sees AI demand, and we are taking a play here at the royalty arbitrage. The V9 technology has hit 25% penetration already. And as this climbs, or let's say the 35 to 40% mark this year, the royalty revenue will disconnect from unit growth, and that rent hike is sticking. And as I mentioned before, the litigation discount, right? The stock is currently depressed. There are fears that there might be an upcoming trial in March with Qualcomm, but we believe that the probability of a business ending verdict is probably just not there. The most likely outcome is a settlement or some kind of manageable outcome. When this fear premium dissipates, the stock will re-rate instantly. So aside from that, there are other catalysts that we can look for. Of course, we got earnings coming on the 4th of February. That's pretty soon. And that will tell us management confirmation on V9 adoption, whether that is accelerating, stalling. But if it does, of course, that validates the margin expansion thesis, putting a floor under the stock price. We have as well all the hype cycle going around the Barcelona Technology Conference that's happening in early March. And then as well, we have the Qualcomm outcome around mid-March. But again, even by then, the stock may have risen significantly to even just 150 at current prices, in considering the volatility of options, which is about 60%. It's pretty confident to have that as a price target. So with all those things, we're getting a high quality monopoly that is temporary on a discount, albeit still a pretty high valuation, signaling that the market is not selling this stock at a discount, yet at very competitive levels compared to the past, right? So we're, in terms of valuation, are buying around half all-time highs in a not so distant future. So that leaves ample room to make money here. And the fundamentals definitely are there in the business model. Now it's just a matter of the catalyst playing out in our favor. In terms of how I structure the trade, it's a classic calendar spread. I purchased already this, the 115 strike in March, excuse me, in May, and sold the 120 in April on a 2-for-1 ratio. That provides us a more than 100% upside, assuming we hit 150, and it can realize more than 3x if we realize the 150 price after the expiry. But of course, we still get the ability to restructure if need be. So pretty straightforward, guys. I hope you enjoyed the video. See you soon.